Warren Buffett bought his first stock at age 11. 3 shares of Citi Service Preferred at $38 each. He sold at 40, felt brilliant for a moment, and then watched the stock continue climbing to 200. His first great investing lesson was not about stock selection. It was about patience. And that early mistake shaped the way he thought about investing for the rest of his life. We spend a lot of time talking about Buffett's results, the billions, the legend, the quotes, the aura. But the real value is in the early process, before the mythology, before Berkshire became a giant, when he was still making mistakes, building mental models, and learning how capital actually behaves over time. That is the part most investors skip, and it is exactly the part that teaches the most. The first 10 investments are not interesting because of nostalgia. They are interesting because they reveal the framework. Patience, cash flow, conviction, research, circle of competence, position sizing, time. These are not outdated ideas. They are the operating principles behind one of the greatest investing careers in history. And unlike Buffett's exact returns, those principles are still usable. Hey, I'm Kira. By the end of this video, you will understand the core principles Buffett developed in his first decade as an investor, what each early investment taught him, and which lessons still apply to your portfolio today. Because the point is not to copy Buffett. The point is to extract the logic behind the outcome. Investment 1, Citi Service, age 11. Buffett bought, the stock dipped, he got nervous, then he sold for a tiny gain when it recovered. Shortly after, it kept rising far beyond his exit price. That experience taught him something painful and essential. Impatience can be more expensive than being wrong. A quick gain feels intelligent in the moment. But selling too early destroys the mathematics of compounding before compounding even has a chance to begin. Investment 2 was not a stock at all. It was a business. At around age 14, Buffett put his own money into a pinball machine partnership. The machine was placed in barbershops. It generated cash. That cash was reinvested into more machines. This matters because it shows how early he understood the difference between working for money and owning assets that produce money. He was not trying to be busy. He was trying to own a machine that kept earning after the purchase was made. Investment 3, farmland. Still very young, Buffett used savings from his paper route to buy 40 acres of farmland and rent it to a farmer. Again, same pattern. He converts labor income into an asset. The asset produces income. That is one of the deepest patterns in his life, and it appears shockingly early. He was not collecting things. He was collecting productive systems. Savings became ownership, and ownership became recurring value. That is the first major principle from Buffett's early years. Own assets, not just outcomes. The stock, the machine, the farmland, each one taught the same lesson in a different form. Wealth is not built by touching money briefly. It is built by owning something that continues producing after you stop actively working on it. The more your life depends only on labor, the more fragile your finances remain. Ownership changes the game. Then came Geico, and this is where the young investor starts becoming unmistakably Buffett. At 20, he took a train to Washington, D.C. to visit Geico's offices on a Saturday. The building was closed. He knocked anyway until someone answered. Lorimer Davidson, who would later become CEO, spent hours explaining the business to him. Buffett did not just read a ticker and place a trade. He pursued understanding with absurd intensity. That intensity created conviction. And that conviction mattered because Buffett eventually put around 75% of his net worth into Geico. That sounds insane if you focus only on concentration. But the deeper lesson is not put 75% into one stock. The lesson is that deep understanding changes how you size risk. Most investors spread money thin because they do not really know what they own. Buffett concentrated because he had done the work. Research created clarity. Clarity created action. This is where the circle of competence principle starts to become visible. Buffett never needed to understand every business. He needed to know where his understanding was strong, where it was weak, and where it ended. boundary is a competitive advantage because it prevents intelligent people from confusing curiosity with competence. The Buffett partnership years then show what happens when principles become a process. Starting in his mid-20s, Buffett began managing capital for family and friends. The point here is not hero worship. The point is repeatability. He was not getting one lucky result. He was applying the same style of thinking again and again: understandable businesses, rational pricing, disciplined selection, and patience. Over time, that process produced extraordinary outperformance versus the broader market. And that brings us to the real meta lesson across the first 10 investments. Buffett rarely moved outside what he could understand deeply. He did not need to have an opinion on everything. He did not need constant action. He did not confuse motion with intelligence. He waited, studied, acted with conviction when the logic was clear, and then gave time room to do its work. That combination is far more teachable than genius. So what can you actually apply from all this? First, buy what you understand. If you use index funds, that principle is already working in your favor because you are buying broad market exposure without pretending to be an expert in every company. But if you pick stocks, the one-sentence rule matters. What does the business do, and how does it make money? If you cannot answer that cleanly, you do not own understanding. You own a story. Second, size your conviction honestly. Most portfolios are inconsistent because the investor's knowledge is inconsistent. A tiny position in something you barely understand is not strategy. It is uncertainty wearing a confident face. If your knowledge is shallow, index funds make sense. If your knowledge is deep and earned, a concentrated position can be defensible, but concentration should come from evidence, not excitement. Third, let time do the heavy lifting: the pinball machine, the farmland, Geeko, the partnership. The pattern is the same. Buffett kept moving toward assets and decisions that could keep working after the initial effort was made. That is what investors miss when they become obsessed with short-term trades. The goal is not activity. The goal is owning something good long enough for time to multiply the result. So here is your move this week. Apply the one-sentence test to every stock you own or are thinking about buying. Can you explain the business and how it makes money in one sentence? If yes, good. If no, that is not a research note. That is your answer. And if most of your ideas fail the test, that does not mean you are bad at investing. It may just mean index funds are the wiser tool for you right now. Buffett's first 10 investments teach 3 durable principles. Patience matters more than quick wins. Ownership beats activity, and deep understanding creates real conviction. Circle of competence is not a slogan, it is a filter. Use it. Subscribe if this helped, and I'll see you in the next video.